This is the August 22 edition of Commodity Week.
Todd Gleason services are made available to WILL by University of Illinois Extension.
Well, welcome to Commodity Week. I am Todd Gleason. Our panelists for today are Greg Janzen. He's from TGM, that's Total Grain Marketing, part of the elevator system. He's located here in Champaign County. And Joe Janzen, agricultural economist, part of the farmdoc team here on the Urbana-Champaign campus of the University of Illinois. Joe Janzen, you and I last week were at the Midwest Extension Outlook meeting. What were the things that were on the minds of the ag economist and the worries they might have?
Yeah, I think our job, and I think everyone's job, has sort of changed a lot in the last year. The market conditions aren't what they were. Prices are a lot lower than a lot of people would like them to be. And I think we have to sort of adapt to that new market reality that we're in for low prices. There's nothing on the immediate horizon that suggests prices are going to move sharply higher anytime soon.
And as you listen to Ben Brown talk about the price of soybeans and Chad Hart talk about the potential price for corn, were there takeaways that have you worried?
Obviously, on the production side, this crop keeps getting bigger. That's the worry. I think the one thing I would take away that's maybe a little bit more optimistic is to recognize that we do have robust international markets for our crops. We're watching export sales very closely. We had an export sales report come out this morning, I think was modestly encouraging. And we have had strong export sales during the week, flash sales for corn and soybeans pretty much every single day this week. That suggests while we're in a period of the year where yes, we tend to get pretty aggressive sales pace, that is sort of coming through, and that those international markets are just really, really important to move a big crop like the one I think we're going to see this fall.
I think I'll have you, Greg Johnson, join me in asking some questions of the ag economist. So when you have one, just give me a signal and we'll make sure that those are in place. I do want to talk a little bit about how the ag economists view the plateaus in the marketplace. These are things that Scott Irwin and Daryl Good did a lot of work on in the mid 2000s. Correctly so, as it turns out, at least to this point, trying to pick where the midpoints are. And I guess when I look at those, what it tells me is there are some really short years for high highs and then a much longer trough that might be below the average of the plateau.
I think that's right. So commodity markets, generally speaking, storable commodity markets are, long periods of low prices punctuated by these spikes. Why do we get the spikes? Because we've run down that global available supply below a level where, a low price can ration that out across time and space. So that's just how these markets work. And we're in one of those periods where, global stocks have been building. We have adequate supply to meet demand for the foreseeable future.
Joe, you mentioned these lower prices have stimulated export demand in corn. How much of an increase can we get? USDA is using 2.3 billion, and can we see an increase in ethanol exports as well as corn exports?
Yeah, I think the one thing to note is that the USDA export number is already pretty big. It's bigger than a year ago. So USDA is sort of building some of that into their expectations. I think the trade is building some of that into their price expectations. So it's more a question of, I think, can we get to where those expectations lie? On corn, I think you're right. I think we still have to see a little bit more. It's a little bit more of a prove it to me kind of situation. We're seeing some of those sales coming in this week. We do have, right, the other thing is aggressive competition in that export market, particularly from Ukraine and from South America. And so we're, the other thing that USDA is building into their balance sheet expectations is a pretty large South American crop coming next year. Brazil's kind of facing the same situation that we are, lower prices, and kind of got to make it up on volume.
What have they been doing with the feed and residual usage?
I mean, that's also been going up. Part of that is sort of, optimism about feed demand and, cattle prices being relatively strong. I mean, they're sort of the bright spot of the ag space, relatively speaking. I know not maybe quite as high as they had been in the last few months, but still that's sort of the bright space, and there's strong demand there. Of course, the hard part is pinning that down. That feed and residual piece always seems to be the toughest part of the balance sheet to kind of get right.
Did the ag economists in the Western Corn Belt that you've talked to uh, believe those that would be the case? Are they saying that there are the numbers there for the beef cattle? Uh, Pork tends to be steady, poultry as well.
Yeah, I think there's a sense in which, yeah, we are building that herd a bit, but I think there's sort of, that process has been really slow, and I think there's always sort of a little bit of skepticism about the extent to which, feed demand will grow.
I- Is it about not the number of animals, and this has crossed my mind a couple of times, but how heavy these animals are when they're going to market, and what that means is it's related to the number of bushels of corn they have to consume or pounds of corn that they must consume on those last pounds that they're putting on.
Yeah, I think that's part of it is this idea that the US cattle herd, those cows are getting bigger, feed demand's growing. That's a pretty slow moving piece though of the overall feed demand. In terms of like getting a big jump in feed demand for 24, 25, I think that's a sort of secondary issue relative just to how big that herd could get.
I'd have to agree with Joe. The feed demand number probably is the one sector of the three biggest feed demand sectors that isn't going to go up very much. If we're going to go up, we need to see exports go up and we need to see ethanol go up, either direct use of ethanol or export demand of ethanol. But feed usage is probably a pretty flat number.
Any reason to think ethanol usage will go up, Greg?
I think so. I think Brazil is increasing the amount of corn that they're using for their own ethanol. They can use up to 28% blend ethanol in their vehicles, and the government has increased that number. So we should see Brazil produce more corn for themselves for domestic use, and that leaves more of the export market to ourselves. And then when you look at Argentina, I just read this week that Argentina's corn acres may be down double digits next year because of the leafhopper beetle and also because of the poor price of corn. So, we may have a little bit more export business taken away from South America than what we had this past year.
Does ethanol usage in other countries, particularly in Brazil, will that really have an impact on global demand?
I think it can, but overall, I mean, I tend to view that ethanol demand piece as pretty, inelastic. It it isn't super responsive to price like export demand can be. So I am really, thinking along Greg's lines that we've got to see it on the export side to really make a difference. And that's the thing I think a lot of people, want this to be sort of like, well, can't we sort of solve this problem ourselves? Can't we solve this problem domestically? I think that's going to be really hard. I mean, when crops are big, we really need that export piece to kind of come in. This seems to be the most flexible component of the overall global corn and bean demand complex, and the part that can kind of dig into a big crop.
Here, Greg, going into the last week and a half of the month of August, how is the cash grain segment adjusting to the coming crop year, and when are the expectations that the first of the crop might come in?
I'll take beans first. There was about a 90-cent premium for old crop beans versus new crop beans about a month ago. And every week we seem to lose 10 to 15 cents as we get closer to harvest time. We're now at about a 40-cent premium, old crop to new crop. Next week, that'll probably be 30, the next week 20, and eventually we're going to get to where beans are beans, old crop, new crop, they're all the same price. And the basis levels for new crop beans are starting to get weaker. We've had some daily flashes of export sales. China may be up, by my count, up to 50 million bushels of purchases of U.S. beans for export. That sounds all well and good until you look at last year. They bought over 900 million bushels from the U.S. So China has a long ways to go. And if we don't see a big export program here in the fall, basis levels could get very weak in the soybeans. As far as corn is concerned, the same thing, although we didn't have the big old crop versus new crop premiums. Those were more like 20, 30 cents. We've seen those go down to about 5 cents. There's still a little bit of a premium for old crop corn versus new, but not much. And harvest for corn will start sooner rather than later. In fact, in Arkansas, the first field was cut today. It came in at 200 bushels of the acre, about what they thought. So harvest for this year has actually started down in the south. As far as basis levels are concerned, again, export business is starting to pick up a little bit, but we've got a big 2 billion bushel carryover from last year. farmers are not completely all sold out of the old crop. So not only do we still have to get rid of the old crop, but now we have to get rid of the new crop, which looks to be about 10% bigger than where it was a year ago.
When you think about how much corn, old crop corn, has been left around or in storage in the middle of the summertime and late into the spring, there were many suggesting that the Western Corn Belt still had a deficit of corn within it based on dry weather conditions, not from last year, but from the previous year. Has that played out in that way? And then we'll ask some more questions of you as well.
Yeah, we're seeing basis levels in Texas, Oklahoma, Kansas, Mexico. That market is still strong, not as strong as it was 2 years ago. 2 years ago, basis levels, if you were on the right railroad and could get it to the southwestern U.S. or Mexico, you could get 90 cents to a dollar over what corn was worth here in the central Midwest. Last year, it was more 50, 60 cent premium. This year, there's still a premium, but it's probably 20, 25, 30 cent premium this year.
Yeah, I mean, the other part is to think about just sort of, what do we do, what happens with levels on the river and sort of grain movement? What does that look like going into the fall? What's your sense of that, Greg?
Yeah, water levels are really low. That's kind of something we haven't been talking about. But maybe we should have been talking about. Levels on the Mississippi at Memphis are really low, and river levels lead to higher barge rates. Higher barge rates lead to weaker basis levels because it costs more to get it from point A to point B. So if we don't start seeing the rivers rise as we get into the new crop export time frame, we'll probably see basis levels slip a little bit to reflect that higher cost of transportation.
Now let's talk about what producers may or may not want to do at this point. Let's start with the fact that um, they have grain to sell. Let's just stay at that point. If you have new crop corn to sell today and new crop soybeans, when you're thinking about looking forward into the pricing structure, um, and you have bills to pay by the end of the year, I think I'll make it easier on you at this point. What do you do to cover those bills?
Well, I think you've got to think about, I mean, making some sales. Now, I hear varying stories about this, about the degree to which, the farmer is cash constrained and needs to move grain at harvest. Obviously, that didn't play out. I mean, we had farmers holding on to a lot of grain last year. And we tend to see, a significant chunk of farms holding grain, certainly over that December 31st. That January 1 tends to be a very popular day to sell grain for, for especially for tax purposes. Um, but there's a degree to which I don't know how constrained the farmer is, and we've come off of a number of years in which, balance sheets have looked pretty good. We've built up a nice uh, buffer of working capital. I think we're going to eat into that a little bit this year, and probably given the low prices, I mean, farmers aren't going to be super motivated to move a ton of grain. Now that may change going into 2025.
So your view here is that if they have cash on hand, whether they should or should not sell won't be the motivating factor. It's that they can manage to pay their bills regardless.
That's kind of what we've seen play out here, I think. And we do see sort of just a strong reticence to move a lot of grain right at harvest. Obviously, that is also the time of a seasonal low in the market, typically, and probably one that we'll get here this year is, we're going to get a big slug of corn moving in that gut slot of harvest. Now, does that mean that's the right marketing strategy? I think we got to think really seriously about, we have a lot of grain to get marketed. And you don't want to sort of put all your eggs in one basket. I think some of that grain has to move at harvest, really, just to kind of like spread out some of this risk in terms of trying to time what is a pretty uncertain market.
I agree with Joe completely. You don't want to have both old crop and new crop unsold, because if the price goes down another 25 cents, not only are you losing 25 cents on one crop, you're losing 25 cents on two crops, and that's a 50-cent loss. Do you really want to risk that much? And I know the price is terrible. I've talked to producers and they've said, what do I do? And I said, just break it up and sell some every Wednesday between now and when new crop starts. And when they sell it on that first Wednesday, they say that's not a good price. But then the next Wednesday, they say, last Wednesday, that was a pretty good price. I wish I would have sold more. And we've still got 4 or 5 more weeks before harvest starts up here, and you just have to have a disciplined plan. I know it's not a good price, but I don't think you want to hold two crops going into fall, because who knows how low this goes before we overdo it and start bouncing back.
I think I've asked this question before, but I want some clarification as it's related to the length of harvest, the length of the planting season as well. It appears, I guess, that the crop in Illinois, particularly, is maturing fairly quickly. I don't know what that means as to harvest date at this time. Maybe you have a better idea for me. But if we are able to spread harvest out over a longer period of time, does that provide support to the marketplace, or is the marketplace not really worried about how long it takes to bring the crop in?
If the crop all comes in the same 3 to 4 week period, uh, elevators will have to basically sell cheap trains to stay open. So you could see basis levels get very, very weak for a short period of time and then bounce back. If it's more spread out, which I kind of think it will be, because we planted some corn in April, some corn in May, first half, some last half, some in June, some replant. So if the harvest is spread out, hopefully we won't have to make those forced, I call them almost puking sales, that really depress the basis levels. Now, that's the good news. The bad news is then it doesn't need to bounce back all that much basis wise, after harvest is over. But at least if the harvest is spread out, I think that prevents the basis from getting, dramatically weaker. It'll get weaker, but just not dramatically weaker.
Is space at a premium in the elevator system across the United States at this point, or is it wide open?
Oh no, space is at a premium. If you're a farmer and you have bins, those bins are going to pay you 25 cents to hold on to corn until January, probably pay you 40 or 50 cents to hold on to it all the way into the summer. For beans, even more than that, 50 cents into the spring and 65, 75 cents holding beans into the summer. You need to lock in the carry. You need to sell those deferred months and then wait for the basis to improve. But storage is going to be at a premium this year, no doubt about it.
We've talked a lot on the recent closing market reports, even on Commodity Week, about trying to lock in the carry and what that means and how you can go about doing it, either just as a simple cash sale in one of the out months. I'm going to sell in March and get a bid from your local elevator, or by using the two-step program where you're hedging as well as locking in the carry in the marketplace in some form. Can you talk to me about the economics of doing that, Joe, and what that really means?
Yeah, I think it's really about thinking, okay, I can see that carry in the market. Greg's told us what it is. Now, can I justify that with the costs that I have to incur to get that grain out to January, March, July, whatever that time horizon is? That's a little bit incumbent on sort of, what kind of, physical setup do you have? What kind of, do you have bins? What's the cost of moving that grain in and out of storage? And those things are kind of hard to pin down sometimes. And then the other part is that opportunity cost. What could you do with the cash that you'd get from making that sale today? And does that outweigh, the cost of holding that money as grain? And so we know that interest rates are higher. Hopefully we maybe get some interest rate relief. I think the market's looking for a little bit of relief on interest rates coming into the fall, based on sort of, global economic conditions. But ultimately, that opportunity cost of holding grain in the bin, not getting paid for it, is bigger than it's been for the last 10 years. It's bigger today than it's been for a long time. And you really have to think about, is it worth trying to eke out a nickel or a dime storing this grain 1 month more when I could get that money today?
Let's just talk about getting it to January to begin with. So, what would a farmer uh, at the elevator system be able to sell a bushel of corn for in January? What's your in charge? So, what might they be able to make out of that? And while you're coming up with some of those numbers, when I was talking to Frayne Olson last week from North Dakota State University, I asked him this question. He gave me an explanation that when he's out talking to farmers in his state, that he simply says, the elevator system's really good at figuring out what it costs to store grain. And if you want a quick and dirty way to do it, just use their figures. So to get to January, in charge to get another month of 3 cents or 4 cents or whatever it costs. So what are the differences in those?
The January bid is 25 cents better than the fall bid, and DP rates or storage rates are probably going to be 20 to 25 cents. So if you don't have your own storage, you're basically just going to pay the elevator that carry cost. It will pay if you have your own bins because it may cost you 1 or 2 cents a month for those 3 or 4 months. That's 8 or 10 cents, and some interest is another 5 cents. So it may cost you 15 cents if you have your own bins, but you're going to be able to pick up 25 cents in carry in the corn market till January, and even more as we go out into March, May, and July. And I know that doesn't sound real attractive. In the good old days, the last several years, the market may move 20, 25 cents in 1 week. And so you can make that carry, or you could have made that carry with just the market moving. But in this kind of a surplus environment, getting corn to move more than 5 or 10 cents in 1 week is going to be a struggle. So we may have to go back to the old what I call block and tackle and just be satisfied with locking in, 15, 20 cents above and beyond the cost of storage and interest by capturing the carry.
And I think, the other point to follow on Greg, who's absolutely right here is, yeah, that's right. You'd hope that you could get, 10 or 15, 20 cents in cash, in sort of futures price appreciation in a week. But the market can easily move the other way. We saw that today in the bean market, with bean market down 20 cents or so. So really kind of, focusing on fundamentals, and really kind of being disciplined, and then getting that 20 cents and securing it now rather than, waiting and hoping. Hope is not a marketing strategy.
Selling 2 years worth of a crop is hard enough. Selling two different crops also complicates that matter. Uh, Dealing just with new crop, uh, which is most imperative for producers, do you think, to make sales on to cover their bottom lines at this point, corn or soybeans?
Beans will be the easier sale because $10 beans at 75, 80 bushels probably just about covers their input costs. Corn, I can't come up with a scenario. You can't, unless you're growing 300 bushel corn at something sub $4, it's just not going to cover the cost. So, if you can make some money selling beans and limit your losses on corn, that's probably the strategy right now. But if you need to make some sales right away, I think beans are closer to break even than corn.
Yeah, I agree with that. The only thing being, I mean, if you're really thinking about that storage hedge, the interest cost on a bushel of beans is bigger than the interest cost on a bushel of corn, just because every bushel of beans is worth, 2.5 times what a bushel of corn is.
What are the things that we haven't talked about today that are on your mind as it's related to the marketplace this year or over the next 5 years? And maybe I'll start with the ag economist who thinks longer range as it's related to the economics of agriculture and grain and oilseed production.
Yeah, I think the big one is, we've talked a little bit about it already, but international trade and just how important it is to these markets, and what kind of, we have a, two-party system in this country that neither party of which seems to be big on, promoting international trade and opening markets for agricultural commodities. It's much more of a defensive stance at this point, and we've seen, just how important it is. I was talking to one of my colleagues at Iowa State, Chad Hart, who said, like, we can see it in the data. We've made big sales, export sales of grain to Colombia in the last few years. That's the last big free trade agreement that we signed as a country from the United States. It was the United States and Colombia. And that happened 10 years ago. We really haven't signed a big trade deal since then. Really haven't opened markets. That's something that I'm thinking about longer term. How do we sort of get ourselves on a stance where we can sort of, if we have a big crop to move it around the world?
I think we're in the midst of a reset, similar to where we were 10 years ago. 10 years ago in 2014, we were 2 years removed from the $7, $8 corn following the drought of 2012. And I remember that year, farmers said, "Why would I want to sell $5 or $6 corn?" It was fresh in their memories that corn was $7, $8, and it took a while, but those price levels were removed from their mind, and we started marketing based on $4 corn. I think we're in the same situation here. 2 years ago, we had $7 corn, and that was fresh in farmers' minds. And now I think we've been at these lower prices long enough that we're not getting questions about when are we going back to $7. I mean, it's more the reset is $4 is a realistic price, and what can I do to get $4 corn? So I think I think we're in the midst of a reset. Not to say that we can't go lower when farmers sell in the fall because they don't want to pay the storage charges and they need cash flow. So we'll probably overdo it. But I think in the long run, I think we're looking at a reset of around $4 a bushel.
But won't renewable diesel, won't SAF, sustainable aviation fuel, one for soybeans, one probably for corn, maybe for soybeans, won't those be the salvation?
I think the problem with both of those is, the thing that drives it is policy. Policy tends to be sort of, will, mandate this much and no more. That tends to be really inelastic demand. So once we satisfy that demand, there's nothing that means that prices don't have to fall. If we grow more than that level, we just can't. The market says the price has to go lower to ration all of this out. So SAF, or sort of domestic biofuels demand as a savior, is not something that I'm looking for this year or even in the next 5 years.
Ethanol is an example of policy that has matured.
Yeah, I think that's right. I mean, and we've seen that with just, you look at ethanol use numbers over the last decade, they are very, very stable year over year. The piece that kind of picks up the slack in the global corn market is that export piece.
Are you concerned then that the livestock sector is unable to pick up exports as well because of trade policy as it's related to the two-party system?
I'm a little bit less concerned just because, exports tend to be a smaller share of demand for livestock relative to corn and certainly soybeans and wheat for that matter.
Yeah, now you've introduced a third variable. It's hard enough to predict weather, hard enough to predict demand. Now you're asking us to predict government policy, and number one, who gets in office, and number two, is there enough money fiscally to justify those programs? You know. Good luck. I don't know the answer to that. I don't think anybody knows the answer to that. But when you're at the whims of the government, it's very hard to try to predict a price, because if they don't come through, then we're back to just looking at the demand factors that we know about. But obviously, if the government gives us a little impetus to stimulate usage, whether it's sustainable aviation fuel or renewable biodiesel, obviously that extra demand would boost the market.
Time for a final word from each of you. We'll start with you from TGM, Greg Johnson.
I've been negative. I prefer to call it realistic all year, but people have said that I've been negative on the price, and I guess I still am, because the farmers are still holding on to too much old crop corn. Once that old crop corn gets moved, I think I might stick my toe in the water and say we're getting very close to a bottom, but that may not be for another 4 to 6 weeks. But I do see some positive things out there in demand that Joe alluded to. Export demand on corn is starting to pick up. I think export demand for ethanol could start to pick up. Not real crazy about increased feed demand, but two of those three, we could start seeing an increase. And these high prices that we have had have probably been long enough, and now we're starting to reset to these lower prices. And they always say the best cure for low prices is low prices. So maybe we'll see a pickup in demand, and we'll also see maybe a reduction in acres planted either here in the U.S. or down in South America.
And Joe Janzen, part of the FarmDoc team and ag economist at the University of Illinois. Your final word?
Yeah, I think that 4 to 6 week time horizon that Greg mentioned is kind of really important. At the end of September, we'll get the grain stocks report that will show us just how much of that old crop corn farmers were still holding as of September 1, or at least the best estimate that we have of that number. And I expect it. I mean, it'll be bigger than it has been in the past. I mean, we know that farmers were holding on to a lot of grain back in June, and it's still out there. Greg said, there's still robust movement through the system through now in August. So that over that time horizon, I think we'll learn a lot. I think the key thing for farmers is to really think about putting yourself in the best position so that if there is some of that downside risk over that kind of time horizon, you don't have two crops to market when we get out to sort of 6 weeks from now.
Commodity Week is a production of Illinois Public Media. You may listen to the program anytime you'd like on our website at willag.org. I'm Todd Gleason.